Okay, welcome everybody. Hopefully, we're all here on the other side of the line. Welcome everybody to this week's edition of SelfWealth Live, the technical analysis edition. Here with myself, Roger. I'm from SelfWealth by Saif, and it's great to be here once again for another great show on technical analysis. And that's because of my man here, right on the left-hand side, which is Jason McIntosh. He's the expert here and been in the game for a good 30 years now. So he's our main educator and the person that's really helped us a lot over the years. So welcome, Jace. How are you?
Hey, Roger, I'm good. Looking forward to another good show. Thanks to all our viewers for joining us, of course. And I'm sure we should cover some interesting stocks as always.
All right, fantastic. Well, look, I know there's more than the people that normally comment. So if you're a newbie here, then comment and say hello. And if you're an oldie and don't normally comment, then comment as well and say hello. We'd love to see a lot more people add their tickers in. As you know, if you've been here before, what we do is we go through the major markets that are offered by SelfWealth by Saif, and that is the Australian market, the US markets, and the Hong Kong markets from a technical analysis pricing chart perspective. We go through those and give you our views. And then we will answer some general questions. We've got some questions around stop losses today. So I guess it's always relevant, stop losses, because it's one of the parts of our education that we preach on the most, and that's capital preservation, right? So and being able to use stop losses when we know that our play is no longer going our way, right? So, and then we're going to go into the tickers, right? So make sure you put in at least one ticker on the screen, on the live chat, obviously, and we'll try and get to as many as we can within the hour that we allocate for this show. And then I'll draw a line in the sand when I think there's too many. I'm always late there, but I'll try and be a little bit more on time for you, Jace, and everyone else for that matter. All right, Jace, thanks for waiting, and everyone else. Let's have a look at that disclaimer, please.
So just quickly, everything we do today, general commentary only, no personal advice. And this is the graphic we pop up each week. And this just goes through that. I'm also not part of SelfWealth site. My business is Motion Trader. You'll see my details at the top. Beneath there, the SelfWealth note with licensing, general commentary, all of that important stuff is in that graphic.
Thanks, Jace. All right, so let's have a look at this Australian market. We're not doing much at the moment here in Australia on the markets.
Yeah, so let's start with our chart of the ASX 200, but really, what a difference like 1 month can make. So if we remember back to this time, literally this time last month, Rog, prices were down here at a 10-month low, having fallen 10% in 3 weeks. And it's interesting if people try to remember the fear and panic to sell at the time. And chances are the intensity of that situation has already started to fade from memory somewhat. But 4 weeks back, many people were expecting a full-on crash and the market was going to completely give way. But of course, as is often the case, the worst didn't happen. And this is something we often experience in markets. Every 5% or 10% pullback, it seems like the start of something much bigger. But most of the time, prices stabilize and then recover, as we've seen recently. I think the lesson here is that we shouldn't try to analyze the headlines and then make predictions around the future. It's Rog, I think it's just all too easy to become overly pessimistic and make mistakes. So instead, I think the better overall outcome happens when we follow a robust rules-based plan. We still have losses when markets fall. There's no getting around that if we're in the markets, but our decision-making becomes more consistent, and that can help us avoid emotional headline-driven actions, as I think a lot of people got drawn into 4 weeks back. So what should we make of this latest price action in the ASX 200? Well, what I like about it is that the ASX 200 has continued to hold on to most of its gains. So yes, prices have given back a bit over the last week or two, but so far it's relatively shallow. It's a relatively shallow pullback to around the area of the moving averages. As we discussed last week, when prices quickly move from below the averages to above, what often happens then is you get a pullback to the moving averages. And I think that's what we're seeing now. The key here is for buying to come in and support prices pretty close to where things are now and maintain this as a shallow pullback. And that would be a strong indication that the dip is being bought. The other thing we've discussed in recent weeks has been the potential for a large range. So prices have essentially been moving sideways since around August, and generally within this blue shaded area, and you can see the ASX 200 just crisscrossing either side of the moving averages, and well, that's gone on for what would that be, 8 months or something like that. Now, I think the sell off from the March high, I think that's a volatile pullback within an ongoing range, and it's interesting. The ASX 200 couldn't sustain higher levels in early March, and we know the reasons around that. And it also didn't attract follow-through selling when it was at its most vulnerable in late March. So that's classic ranging price action. And I think it's a sign of a market which is essentially in a holding pattern. I think we could see this range persist for several more months and prices just chop around back and forth. I think the way to play this is to continue holding stocks that haven't given a reason to sell, and then also being open to considering new entries when the right setups appear. While the index might take longer, while this range could persist for a while yet, I think it's an environment where the right stocks can still perform. And as always, I'm coupling my new entries with a calculated exit strategy. So if a stock doesn't perform, I'll take a relatively small loss early, protect capital, and then put that aside for the next opportunity.
Yeah, well, exactly, and we're going to talk about that very soon, using stop losses to do that. What about quickly? Is it the banks or the financial sector and the resources sector? Are they also showing that same pullback?
Well, starting quickly with the materials, we talked about this a couple of weeks about the potential for a range and same price action, strong move from below the averages to above. It's now become stretched. We talk about the potential for a pullback towards the averages, and that's kind of what we've been seeing the last couple of weeks. Momentum's paused, prices are pulling back. There's no drive here to push the ASX 200 at this point either. So this is like contributing to that ranging effect in the ASX 200. And then in the financials, there's no momentum here either. It's sideways. Moving averages are generally still trending higher, but we don't have near-term momentum. And these are the two largest sectors. So when you bring them together and they don't have near-term momentum, well, of course, it's going to impact the ASX 200. And there we are, where US markets are at new highs, but the Aussie market, it is range bound.
Yeah, it's lagging. All right, let's have a look at the US markets then. Where have they moved since last week?
So S&P 500 first. So let me just put this onto a daily chart. That's a weekly on the screen there. So there we go, onto a daily. Well, a new all-time high for the S&P 500 on Tuesday, and that follows a fairly quiet week for most of last week, with prices moving sideways. I think the positive to take from this is that the market's holding its gains well, despite news flow that would probably have been seen as bad just a few weeks ago. But in spite of whatever comes out now, the market is holding firm. Another interesting development is the S&P 500 has now had 3 consecutive weeks where the index has been up over 3% each week. So from these lows, there have been 3 weeks in a row where the index has been up 3% or more. Now that's a rare event. It's only happened 8 other times since the 1950s, and the last time was in June 2020. So that was after the COVID crash. So if we just go back, the COVID crash times, somewhere within this period here, we've got 3% up weeks in a row. So yeah, it's like here we are again. What some 6 years later, and we're seeing that pattern again. Now this is interesting. So after these 8 big 3-week rallies, so it's happened 8 times. This is the 8th time. So after these, after the seven previous big multi-week rallies, what do you think the index looked like 6 months later? And do we think was that a setup for a bust, or was it a setup for more gains? And the way it's played out, in every instance, the S&P was higher 6 months later with an average gain of 15%. So it's people often see big gains and goes, oh well, the market must be running out of steam. It's going to this will be the end. But in each of those cases previously, it's led to strong returns. Now, of course, that doesn't guarantee the S&P 500 is going to follow the same pattern this time around, but as we've been discussing over the last few weeks, I think we should be considering bullish possibilities, not staying locked into a bearish mental framework. The question remains as to whether we're going to get a bigger pullback in the near term. Often we do in these situations. Prices were stretched below the moving averages, and now they're stretched above the moving averages. I still think there's a good possibility that we do get some further consolidation before potentially getting some further gains. But at this point, that near-term momentum is still to the upside. I want to quickly show you one more indicator that I've been looking at through the week. I'm going to jump over to a weekly chart, and I'm going to put on an indicator. I'm going to put on RSI, a relative strength indicator. And what's interesting with this, I'm also going to adjust the parameters for this. So the default setting has the upper band at 70. I'm going to make the upper band 60, and the lower band by default is 30. I'm going to make it 40. And when we do that, viewers have to go through this on their own time to really like study this. But just briefly, I'm looking at periods where there's a strong move from below 40 to above 60, like we've just seen. Below 40 to above 60, a strong move, of course, goes with it. And it's what happens afterwards. What we find is when we get the RSI moving quickly from below 40 to above 60, forward returns tend to be strong. So we'll just go through a few examples. So here's last year, you got that occurrence, and then of course that led to a strong year last year. Here's an occasion in 2023, from below to above, strong period. After COVID, you had the same condition. We can just go back. Let's just go back further in time. Here's a period here in 2010 from below to above. Again, it leads to strong conditions, and it's got a good strike rate over time. In fact, you've got to go back. I believe it's worked every time since 1969. So you've got to go back 57 years to find an example where it wasn't successful. And we just quickly jump back to 1969. And just here where I've highlighted, see we go from below to above, and the market rallies, but then it falls back on itself. So look, it goes to show nothing works all the time, but it has been a strong indicator for a long time. So I don't think we should ignore the persistent buying power that we've seen in the markets of late, and strong money flow. A strong flow of money is often a good indication of underlying strength. Just quickly over to the NASDAQ, new all-time, again a new all-time high on Tuesday, and an important point here is the NASDAQ is confirming the all-time high in the S&P 500. Sometimes it can be a potential warning sign when there's non-confirmation, when you get one major industry making a new high and another one not. That can be cause for concern, but that's not the case here. What's also interesting is the small caps are also at an all-time high, and I think it's positive that smaller stocks are also participating in the rally. So it's not just the Magnificent Seven. There does seem to be broad participation across the indices.
Okay.
Dow and the equal weight are just a fraction below. Oh, here's the Russell, for example. So yeah, new high in the Russell. And then you look at the Dow, it's just beneath its previous high, and the equal weight, again, just beneath its previous high. So uh, it looks like, as I say, that broad participation across the indices. I know there have been many, and there still are many potential reasons to be fearful, but as it stands, the market is looking past those reasons and it's pricing in a better future. I think, Rog, I think a mistake a lot of people make is that they continue focusing on the catalyst for the sell-off. So they'll continue focusing on what was not working a couple of months ago, even when the price action is suggesting something else is happening. So yes, things could get worse again. Volatility could return, but that can be managed. That can be managed with a good exit strategy. That's what we talk about all the time: exit strategy when things aren't working. But for me, the worst thing isn't to lose money. Should I? And I bought Nasdaq. I bought a Nasdaq ETF just a couple of weeks ago as prices got back above the moving averages. The worst thing for me isn't to lose money if I'm wrong on new purchases. Rather, it's to miss out on if prices keep rising and I stay on the sidelines and continue watching.
Yeah, fantastic. I mean, I missed a lot of that, Jace, but I think from what I understand, it's all pretty positive signals from the US at the moment in terms of the share market, obviously. I speak to a lot of people around the markets for my job and all that stuff. And a lot of the times I hear clients will say, not because they're analyzing it technically, but they're thinking that the market is well overbought. And it's funny how you've used that RSI. Normally, from what I learned, from when I've learned things, and things are in the overbought section of that RSI. People are now looking for return or pulled, a drop in the markets, right? But you've also used that RSI as a way for historical context to see that it's gone over, but there's still the year after it's always gone up. So it's been interesting to see the different perspectives and the way you've analysed that, Jason. But then for the people that are waiting for the markets to crash, there's no doubt it might crash one day, but they just don't know. At least we're in a position to go, all right, it is what it is, right? So play it as it is, and not what we think. Not what we
Yeah,
perceive.
I think that's right. I think we want to avoid getting boxed into a rigid viewpoint that we can't move from. I think we want to be flexible with our thinking and be guided by the price action, not our opinions on what we think should happen. It's like after my strategy session, I think it might have been the week before last. Somebody made a comment that the Bears have been wrong, and someone immediately piped up and commented to that saying, no, the Bears haven't been wrong at all. It's like, well, yeah, okay, markets at new all-time highs and it's rebounding after a 10% pullback. It doesn't seem like being bearish has been the profitable strategy. Look, maybe some people did make some money trying to short the market and buy back at the right time, but I find very few people do that. And more often than not, in these declines, it's a case of people selling they're selling shares often that they don't need to, because if they gave them room to move, they can often see off a lot of volatility and prices then settle and stabilize and rebound. We see that a lot. But that's what exit strategy is all about. It's not about having a rigid view. It's saying, okay, I'm going to give it room to move. If it moves too much, I'll get out. If I can stay in, I'll stay in, and I'll let the price action guide whether I'm buying or exiting, not my analysis of the headlines, which invariably we get wrong often.
Mm, mm. All right, let's quickly touch on Asia, please, on Hong Kong and or Hong Kong and China specifically.
So starting with the Hang Seng, not a great deal really to note here from the last week. Prices have pulled back and are trading around the moving averages. We don't really have a great deal. We don't really have any near-term momentum in either direction at the moment. I think the underlying trend remains up. When you just compress this a bit and you look, you just like it, just casting an eye over it, you'd say, look, the overall trend is up. But at the moment, we just don't have that near-term momentum. I think the fact that prices are holding on to just in recent times, we had the rally off the low from March. I think the fact that prices are holding on to most of those gains, I think that's positive. The next step really is for prices to become established around or above these moving averages. And from there, we could potentially look for a rally out of this at the moment sideways structure. And over in the Chinese market, this has just been grinding higher over the last week, and it looks like to me like it might be getting ready for a bit of a pause. There's resistance from these highs. They've got the October and the January highs just above current levels, so that's a resistance point. Prices have also pulled away a bit from these moving averages, so I think there's a good chance that prices do at least pause while the moving averages catch up, maybe just some sideways consolidation. And if that happens, what I want to see is that any pullback remains shallow. That would be a sign of buying interest and an indicator that the path of least resistance here still remains up. I think we'll see the Chinese market at higher levels later in the year, but at the moment it's it's still consolidation or perhaps an emerging trend coming out of this volatile period.
All right, fantastic. Thank you. All right, so we've had a couple of one follow on from last week was one of the viewers obviously come up with having trouble deciding when to sell a stock. Right now, we've spoken a lot about this over previous shows, but let's review today on an individual stock if possible. Jason, I'm not sure if you've got any in mind. But I'll give you one. We'll start with SEMI, SEMI, because that will lead to the second sort of question around the interactive ATR stop loss indicator and how to use that, Jace. So
is the Global X Semiconductor ETF?
Yeah, let's start with this one because I think this was an example from the viewer last week that they wanted to know. They're having trouble knowing when to sell effectively. Obviously, this is quite a hot ETF at the moment. How would we use this as an example to sell if we bought it?
ETFs are a little bit different in that someone might want to hold a long-term position in a particular sector and not worry about a trailing stop because it's like, well, thing with an ETF, it's not like you don't have single company risk. Yeah. So one company can run into trouble, and there'll be other companies there that it's a relatively small position within a larger portfolio of stocks. So this is where, like, holding an S&P 500 or an or an ASX 200 ETF or maybe a semiconductor ETF, and just holding it for years and staying with longer term trends. That can be quite an effective strategy for a lot of people. Other people are happy to go with more of a medium term approach and go, look, I'll go with it while there's momentum. Then when there's not, I'll get out and do something else. So I'd be more. I'm more inclined to use stop losses on individual stocks rather than sector ETFs. But look, just looking at this one here, it's like, well, the trend is clearly up. There's the moving averages have been positive since mid last year. It's having a strong run off the lows now. So this would be let what's working continue to work. It's like, yeah, look, I think if we're going to talk trailing stops, it's best doing it with the individual stocks. Yeah, like on an S&P 500 position, like if you want to have a longer term holding of that, I think that's completely reasonable. So look, this one here, trend remains up. If I was holding this, I'd continue holding it. And I'd be monitoring the overall price action while the moving averages are up and the price is above the averages. That's all good. I'm not looking to take profit. It's when the moving averages cross to the downside and the price is below it. That's where, if I was more medium term, I'd consider, do I want to lighten that position? Looking at an individual stock, like one that comes to mind is Computershare. So This is where a trailing stop strategy comes into play. So we've got a trending period where prices are moving up, and then we've got a clear change in structure where prices drop below the moving averages and the moving averages cross, and we get a series of lower lows. That's where the underlying trend changes, and that's where a trailing stop can help get you out of these stocks before a downward trend continues to evolve. And so this is the sort of situation I'd be looking to use a trailing stop. Probably not so much on the ETFs.
Yeah. Obviously, it's always relative to the instrument and to your goals and everything like that. But in general, now, let's say we got into this around, was that November 2025, when, well, yeah, just around that. Then when you let's say, or is that after that when you would have got in? How would you have used that interactive?
An initial motion trader signal would have been back in around August 2023 as
Mhm.
moving averages first cross, and after a downward trending period. Let me put on. There's a trailing stop we use here sometimes, and I'll use that. This isn't the motion trader stop, but it's an ATR based stop, so it gives us an idea of where a stop would have how a stop would have worked. And so where'd I say? Around here's our entry point. So this is a 10 ATR.
So with that, just to stop you there, just to follow on from the client's question, how did you set that entry price on the indicator? If that's okay, Jace, can you demonstrate that?
How'd I set the entry price?
Yeah, where you entered. How did you?
Okay, so I'm just going off the motion trader rules. So 50 and 100 day moving averages need to be positive. So they've crossed and turned higher in July 23. And then I use a 70-day high. And now the 70-day high is going to be probably going to be around here in September 23.
And
So
is it that dot, that blue dot that you use to, see, there's a blue. Is that the thing? That's something. Yeah.
I position that roughly around the point. So
Yep.
it's roughly around, I'm
Okay.
estimating where a motion trader signal for this stock would have been.
Yep.
Now we can bring that across. And so you can see it hasn't gone up in a straight line. Initially it gave a signal and started to fall back, but with a wide initial stop, it gives it that time to have that volatility within a potentially emerging trend. The wide stop saw off the pullback, started to rally again. It's continued to be back and forth and reasonably volatile, but then a good upward trend has started to emerge. Prices has run for about how long? About a year, from October through to August, so about 10 months. Prices come back below the averages. The averages have crossed. That's not a sell signal in itself, but it's a sign that there is vulnerability in the share price, and it's time to say to yourself, look, just be sure where's my exit point on this? Where am I going to cut my position should this continue to deteriorate? This is the advantage of a calculated level. It takes away the guesswork of saying, oh, I'll give it a little bit longer. Once we start talking like that, we end up giving it too much longer and selling becomes difficult. We talk about those stocks almost every week where people have been in stocks which are down 70%. You can see where the price hits the trailing stop in December. That's the exit point. People often worry, oh, if I sell now, it's going to bounce back. It's like, if it bounced back, well, so be it. It's not the stocks that bounce back that cause havoc in people's portfolios. It's the ones that continue falling. And so far, this has been one which has continued falling. It was a good one to exit back late last year. And some people will say, oh, well, I wanted to get out earlier. I should have got it. We should have sold it as soon as it went below the moving averages. And I just don't think that's a reasonable thing to say in hindsight, because if you do that, well, we should have been out of this stock when it was below the moving averages, not long after buying it. Oh, actually, very soon after buying it. Then it's below the averages again. There's got more time below the averages. You've got to give these stocks room to move. Then there's this sharp decline from the February high, which the wide stop saw off. The stock rallied again. It didn't continue, but it could have. And this is how we can stay in trends which might last 2 or 3 years, where they just keep going up. Got to give them room to move. Got to accept giving back profit at the end. That's the only way of staying on really big trends. But it does give you that definitive exit point, which is calculated, not guessed at.
All right, fantastic. And what are the settings for this? You just use the default settings for this indicator here, or?
No, look, this again, this is not the motion trader stop. I'm just using this because it's available within TradingView and it's an ATR stop, which is adjustable. So it's different to what I use. I think I've got a more rigorous calculation, but this is a good for demonstration. I put it on. This is where is it? Here it is. Here, interactive ATR stop loss, and then in brackets you've got a name there. Then I go into the settings, and inputs. It must be. I go into inputs, and this is a key one I adjust. It's a multiplier. So an ATR stop. It's the average true range, which is essentially the average trading range. This is calculating it over 14 days. So it's getting the average trading range over the last 14 days. It's multiplying it by 10. And you can play around with some of these things and we'll move it around a bit, but essentially 10's a nice wide trailing stop. A lot of people like to set their multiple at 2, 3, 4, or maybe 5. I think it's way too close. Let's just do that for interest now. Let's set an ATR of 4 and see what happens. And well, the trade doesn't get very far. Let's set it from another point. Let's say we get in. You can see how closely it hugs the share price, and that's great when you get a really strong upward phase. But yeah, most of the time you end up being chopped out of stocks which during pullbacks. So it's using that wide width of multiple of 10 to give it lots of room to move and try and stay in a trend which could last 1 to 3 years.
All right, fantastic. Thanks, Jace. Michael, to move the blue dot, you just got to hold down on, as you've probably seen Jason do, you just got to move the hold down on the mouse button and move that blue dot.
It's left click on the dot and then just maneuver the dot to where you want it.
Yeah. All right, fantastic. Well, I hope that sort of gave people some context around stop losses.
If you want a proper calculated stop loss, which isn't just by some indicator on a trading software, it's like that's what Motion Trader does. That's what I do. It's and it's adjusted again to I've made some variations to it to make it work for what I wanted to do, and it's calculated, it's consistent. And I think that's what we want for good trading process. We need consistency and we need something which has been tested and which has a good track record of working in various situations, of seeing off lengthy consolidations or pullbacks or whatever it might be, and giving us that potential to get on large trends.
I think that's the key word, right? Consistency in the variables that you're going to use for your stop losses, right, or even your entries. That is the key. But there's a lot of videos we've done in the past which you can review right from the start. That we talk a lot about how we enter and exit positions. Once again, I encourage anyone to just go back to the playlists on this channel, or even better, go and check out, obviously Jason's Motion Trader, and it's all in a PDF and video format there for them, isn't it, Jason?
Yeah, lots of information on the within the service.
And all right. Let's start off with some tickers. We're going to start off with Roberts, please. HMD, please. HMD.
Yeah, there's a trend in play here. Moving averages up, it's above the averages. Got that nice rally from late March. That's a strong rally, and then the price action since it looks like a corrective sort of pullback where it's finding support, like it's pulled back and it's just hovering, consolidating above the moving averages. So it looks like there's buying interest on the dip. If I had it, I'd continue holding it. You'd probably find there's also some support coming through around those previous highs. If someone's particularly keen on it, if we wanted to buy the dip, this is a point to buy the dip, and then possibly having a stop loss about. It's still probably about 15 to 20% lower. But it's asymmetric because your upside is then quite open. It's a low price stock, so low price stocks always carry, I think, a lot more risk. Once we're talking like 4 cent stocks and such. But yeah, look, there's something to go with here. Alternatively, if it continues to hold and then breaks higher, that could be an entry point there. But yeah, there's momentum. Let's see where it goes.
All right, fantastic. Next one is ELS, please. Adonis, you've got quite a few tickers, so we'll just start with ELS, and then if we've got time at the end, we can always come back. But
Yeah, Adonis, a place for you is Friday's strategy session where I can go through more stocks. We can
especially
only just
gold as well.
look. We can only just do one here, but if you want more, Friday's strategy session is the place to be. Yeah, look, trend here is up, rising moving averages. I'd be staying with this stock. I'd probably hesitate to buy it just because it's like the pullbacks have been quite short, which is a positive because it shows the buyers are prepared to step up early and not wait for it to come back to the moving averages. So this is why I'd very much be staying on this one. It's just like if trying to buy it currently, where do you put your stop? Yeah, look, maybe I probably wouldn't buy this one at the moment. I'd rather just hold what I'd bought at, hopefully a much better level, much lower level earlier on. Buying it now, I feel the stop would need to be back at least below the 50-day moving average. It's come a long way, and it's also come from 30 cents. So that's what's that? That's more than a 20-fold increase in a year. So yeah, look, I'd hesitate to buy it, but I'd certainly be letting it run.
Yeah, thank you. Next one's from Blue. EVN, please.
Yeah, look, overall trend in this is up. I've got some of this. I've had it for years and years, which I continue to hold as a long-term holding. Again, I talk a lot about gold in Friday's strategy session. That's a place for more in depth on gold. I suspect gold may consolidate for a number of months now, which would probably then, of course, see the miners do something similar. I'm just not sure we're going to see a re-acceleration like to like what we were seeing into the February high. I think it's going to take time to consolidate those big gains we've seen over the last couple of years. So in that case, I'm not in a hurry to do any buying, but depending on this is a motion trader stock. It's still in the portfolio. There's a calculated stop loss on it. So if I was looking at it from a medium term perspective, I'd be using the wide trailing stop. See if we could see off a potential further consolidation and stay on the trend. But if it comes back, well, then I'd exit if I had that medium term positioning in mind. As for me, it's longer term. I'm happy to let this one run. But yeah, I think there's a good chance we see more consolidation over many months.
All right. Next one is PAT. Laurie.
Yeah, low price stock which has taken off. If I happen to have some, if I happen to buy it before it took off, yep, I'd continue holding it, see if it can sustain its gains. Like I probably wouldn't want to see it back below. Say, you can see this blue horizontal takes in some previous highs, so I probably wouldn't want to see it back trading down around 6 cents. But in terms of buying it, it's too much risk. Like to buy it at current levels, I kind of need like a 40-odd% stop. It's too big for me. So I wouldn't be a buyer of this, but I could hold on to a position I got if I bought it early on before the breakout. As it got above the moving averages, I could let that run, risk giving all my gain back for the chance of it stabilizing and going on to a much larger gain. That's the way I'd play it. But always bear in mind that I think most of these low price stocks that go on a bit of a run, most of them don't go on to big, long lasting, sustainable trends. So, yeah, always pay a bit of extra care with low price stocks. They don't all. A lot of them don't persist with those gains. But yeah, if we can manage our risk around it and we're comfortable with how much is on the line, it's like, I'd let the trend run and see what happens, because some of them can go a long way.
All
So
right,
it's
fantastic.
always a case of let winners run for as long as possible, but manage risk around them.
Thank you. What about CCL, please, from Rainman? Would the current share purchase plan offer impact your decision?
Share purchase plan, no, because you can see the market has received it well. The shares have gone up. They're at new highs. Moving averages are up. It's trading above the averages. There's a strong rally off the March low, and the shallow pullback since the recent high is a positive. It shows that there's interest in buying this stock. So the market doesn't seem to be worried about the share purchase plan. Good example of where a wide trailing stop could have seen off the pullback. So, like, you look at this pullback from the high during March when there was so much panic around. It's like what I said earlier about people selling stocks they probably didn't need to sell. This is one of those stocks which I'm sure people got out of because they were just generally fearful. But the pullback really didn't warrant it. If you had that wide trailing stop, that was survivable volatility, which has now led to new highs. So I think like I've said a few times in recent weeks, I only want to sell stocks that I need to, and I want my selling to be systematic, not emotional. And if we kept ourselves systematic on this pullback with that wide trailing stop strategy, it's a good example of a stock which didn't need to be sold. Trends up, happy staying on it.
Okay, fantastic. Thank you. Next one is CXO, please.
Yeah, like a number of lithium stocks, there's good momentum here. I'd want to be staying on this one. I was on board. Um, there's certainly volatility with it, and this is why I use that ATR stop, the average trading range stop with a wide multiple. If you're just using a 25% stop, like look at that pullback there, that's 48%. So you're not going to see that off with a 25% fixed stop. But if it's a ATR based stop, I think would be interesting. Let's just have a look and see whether the ATR stop saw that volatility off. So where's the initial entry? This is where I'd be buying it. The moving averages have crossed. There's a 70-day high. Let's put on a trailing stop. And yeah, the trailing stop has seen off all this volatility. And this is a thing. People say, oh, it's too wide, but it's a calculation. It's calculated based on the stock's volatility. It's a volatile stock. It needs lots of room to move around. There's no point putting a 25% stop on a stock that moves around considerably. You've got to give it proportional room to move. That's why this calculated method, I think, is so good at helping stay on some of these big trends. So I'd certainly be staying with this one. I wouldn't be. Would I be a buyer here? It can't. Do we buy the dip here? Possibly. I'd probably give it a little bit more time and just see whether it does. You get more. It starts to stabilise around here a bit more. If we see a few more weeks where it just tracks sideways, that would become a dip I'd be interested in buying, and with maybe like a 20% stop. If I was super keen, I could buy it now. I'd probably be inclined to wait, but it's the sort of stock, yes, I'd want to hold. Yes, I'd be looking at buying the right sort of dip to get on board. Like here, do we get price action like we saw in December, where it just works off that overbought stretchiness above the moving averages and then runs again? I think that's what we could see. So yeah, it's a one which I like.
Okay, fantastic. Hi, Astro. Let's have a look at CHC.
Yeah, it's struggling below these declining moving averages. For me, this was a motion trader stock, which I think hit a stop loss not that long ago. So I'd probably be out of this one if my memory serves me correct. I think that's big enough to. It's like this isn't as volatile as like something like CXO core lithium, so it's not going to have as wide a stop. It's going to be wide, but it's going to be wide proportional to this stock's historic movement pattern. And I think this fall is big enough to trigger a stop. What's that? That's a yeah. Look, I'd say yeah. This for me would have been an exit during March. It would have been a systematic sale, not a panic sale, a systematic sale. And if I happen to still be holding it, I could probably say, look, I've seen off that sell off into the March low. It's had a strong rebound to the moving averages. It's holding onto those gains so far. So maybe I'll hold it and I'll just have my exit below the March low. That would be my line in the sand if I happen to still be holding it. If I wasn't in it, I'm not looking to buy it. I need it to be back above the moving averages. I need the moving averages to turn, and that's all going to take a little bit of time. So yeah, depending on the situation, but yeah, it's not a buy for me at the moment, and that would be my strategy if I was holding it at the moment. Where's my line in the sand? It'd be below those March lows because I want to avoid a situation where it's rallied back to the moving averages, and then the rally gets sold into, and we look at this in 12 months, and we're down here. I'm not saying that's going to happen, but it does happen, and it could happen. So that's why I've got to have that line in the sand where I say, enough's enough, I'm out. So then I avoid the possibility of being stuck in this in a year later going, well, now it's down 60%. Now what will I do? So keep our losses relatively small, control them on the downside. Because what we don't want to be in this situation. Do I just see whether I'm remembering the right calamity of the week? Now there was another one which is down even more. Well, this is an example of what we don't want. It was, I can't remember which one it was. It's one of the medical ones. It's not.
Pro Medicus, maybe.
No, it's not that. I thought it started with a C. I don't know. Maybe I'll come to it later on. But it's like a gap lower. It's down a lot, and then it had a 40% drop through the week. And it's like, it's a stock we've looked at here over the last few weeks. And it's like, well, we've said this is not the situation we want to be in. And it's like gone from bad to worse. We'll come back to it if I think of it. But so there we go.
Well, that's a good example, though, the CSL one, though, because such a big company, obviously in Australia, such a big name. You're not selling if your strategy is a long-term hold, right? And if you feel like you believe in this company, you've got other reasons to be in this company fundamentally and all that. But obviously, if you're following us and you're following this technical way of doing things, then you don't want to see a whole bunch of these stocks doing what that CSL is doing, regardless of the stature of the company, right, Jace?
Yeah, and this is my point with the stock we're just looking at, Charter Hall. It's not to say this is going to happen with this, not to say Charter Hall will mirror this. It'll have its own unique price action, but this is the situation I want to avoid. That's why the line in the sand is so important to say, okay, we've given it room, we've given it plenty of room, but it's still letting us down. It's got to go because I just can't be in a situation where I'm holding a stock like this. This is just an unmitigated disaster if this is in my portfolio because I've had all this time to have taken action, and if I haven't done so, I'm very disappointed with myself. Fortunately, I don't have any examples in my portfolio like this because I do take that action of going, okay, enough's enough, it's got to go, and more often than not, that's been a good decision. It's sometimes they rebound and it's like, oh well, but most of the time I'll look back in 6 or 12 months later and go, yeah, that was the right call. And when you add up the overall outcomes, cutting stocks which are not performing is the best overall play for my portfolio.
Is it COH, the other one you're thinking about?
That's the one. You started with
some of the viewers have pointed out.
Yeah, disaster, and it was completely avoidable. I'm sure we spoke about this in recent times, and it's like, well, people say it's fallen too far. Looking at here, people say it's down so much already. Surely it's such a big company. It's such a good company. Surely it can't get much worse than this. This must be near the low. It can always get worse. That's real. That's not a special dividend being paid. It's not a mistake in the data. It's real. It's a big company which dropped 40% in a day. The bad stuff tends to happen below the moving averages. So that's why we have an exit strategy. Anyone without an exit strategy is more exposed to the potential of this sort of decline. So yeah, always be wary of risk. When something's working, let it keep working, give it plenty of room. When it's not working and you've given it enough time, be ruthless and kick it out. And if it comes good later, so be it. But you can't have a portfolio with this sort of too many mistakes like this. It ruins it.
All right, thank you. All right, we've got a few stocks to get through to end. So Ozstar, we'll leave gold and silver for Jason's strategy session. Go check that out on Friday. Yes, Jason, is that right?
Yeah.
But I mean, we've already mentioned a gold stock anyway in previous chats here. Let's have a look at YRL, please. Okay.
Yeah, not really. Like there's signs of interest. Like these big pushes higher are interesting. But like the first one, it quickly gave it all back, so that's not good. The rally was sold into. This last rally it's been sold as well. Not quite as aggressively as the first one, but nonetheless, it rallied and then it was sold into. So why is that? It's like users coming out of the company, but someone's using that news to sell into. So it's not a market which is going, this is really good stuff. Let's accumulate it on the pullback. It's the higher prices are being used to distribute into. At this point, the moving averages are declining. It's below the moving averages. I'd have to leave it alone. It's not to say that you can't get, like, it could like pep up from here and get back above the moving averages and go on a big run. It is possible, but from a risk perspective, I don't want to buy it or hold it at this point because it is below those declining moving averages. It has had a big pullback. If I did have it in my portfolio at the moment, maybe I'd have to set a line in the sand. I'd probably set it like 17, go fine. Look, if it comes back another cent, enough's enough, I'm out. Because what if it continues dribbling down and is down at 4 cents? Could happen. It's happened before. So protect our downside with a defined exit level. And in terms of buying, I'd really want to see it established above the moving averages. For me, this one's a little bit too hard.
All right, fantastic. Let's have a look at the next one, please. NXM.
No, it's below the moving averages. I also don't like the consolidation. So it's had a steep fall and it's had a shallow bounce. So that's the opposite of like having a shallow pullback. This has had a shallow rebound. So that suggests there's selling, which is coming in and selling into any rally as it approaches the moving averages. So I think the path of least resistance is lower in this stock, and the risk is that it continues to fall. Nothing certain, but if I had to say, look, which is it going to hit 4 cents or 6 cents first? I'd be betting on 4 cents because that's we've got lower lows, lower highs, declining averages. It's a vulnerable setup. It's not one that I'd want to be stepping into.
All right, thank you. Next one is MHJ.
This was a motion trader signal not long ago. It must have been in February. It had this time below the moving averages, re-established above the moving averages. The averages crossed, got a break higher. This was looking like a prospective trade. It was looking interesting. But then this is the thing. Not every breakout is going to be successful. And particularly when you couple it with the selling which happened in March, This has followed suit and turned and broken lower. How far has it come from its highs? I'm not sure whether this has hit the motion trader stop loss or not. It would have come very close. If it didn't, well, I'd be holding on for now and see whether this rebound can extend. But if I wasn't in this one, I wouldn't be stepping in to buy it now. I'd want to see it back above the moving averages, and yeah, I'd need to see it re-established above the moving averages to consider it as a buy. It's like this is why my approach involves many relatively small trades, because we never know which breakouts are going to lead to the best trades, and for that matter, which breakouts are going to lead to profitable trades, be it a modest gain or a mega gain. Because a number of them are going to fail and end up in losses. Like, maybe this one here, it's a breakout. Everything looked good. Even in hindsight, I look at this. If you're just showing me this structure today, I say, yeah, I like this. I could be a buyer here. I can have a stop below the averages. Let's give this a go, because I know a portion of them are going to run a long way, and I can make a lot of money. And the ones that fail, I can keep my loss relatively small. So there's nothing wrong with the setup, but it just hasn't worked. And it's like, if we're accepting of that and we're prepared to take losses, but keep our losses relatively small, well, we're in a position to take risk and make trades. And we accept they're not all going to play out. But I think that repeatable process that looks for breakouts above rising moving averages is the best way I know to get on those big trends. But it means a stock like this is a stepping stone to the next breakout that does run a long way.
Okay, thank you. Next one, ELV. Have we looked at this one? Oh, that was EVL. So this is ELV, isn't it? E for Edward. Lithium, LV, lithium.
Yeah, we looked at this. I think it might have been last week or the week before, but this was brought up. I've got some of this myself, and I bought some. It was after we looked at it here. It's a viewer bought this up, and I looked at it and thought, yeah, it's a good structure. And I bought some. Where did I buy? I think I bought probably bought around 10, just above 10, and it's having a nice run. So I'm happy to stay in this one and see how it goes. It's similar sort of structure to other lithium plays like CXO we looked at earlier. It's had that big initial rally, had the volatile pullback to the averages, wide stop strategy, could have seen that off, and now it's had another breakout or it formed a trading range, another breakout from that. So trend here is up. It'd be a harder one. I wouldn't be a buyer now, because I look at where do I need to put my stop, and it's too far away. It's almost 40% above the 50-day moving average. So this is now one to hold rather than one to buy. Have a look at the next consolidation. Maybe that creates a new buying opportunity. But let it run. I think the strategy is let it run, see where it goes, give it plenty of room to move. My stop on this would be below the it'd be back below the 50-day moving average at least, and see what happens with it.
Where you enter just above 10, how did you calculate your stop loss from there?
It would have been I'm pretty sure it would have been saying this. I'm just thinking whether it was my Friday strategy session or with you on Tuesday, Rog, and just looking at the big move up was Friday. So actually, it could have been either the Friday or the Tuesday, and I would have looked at around here and said, okay, I need a stop back below the 50-day moving average, and I'm also looking at that low point from mid-April and going, can you just get back below both of those? And that was about 25%, and that was at probably the outer range for me for an initial stop, and that seemed like a reasonable play. So we've got a breakout. I can have a stop back below where it's broken out from, below a moving average, below a previous low, and then if it runs, well, then I can add a calculated trailing stop. But just for an initial stop, that's how I would have been looking at it. And I've gone, well, 25% versus what's my upside on this? And looking at this chart, well, is it a stock that could double? I think absolutely it could double. So risk 25%, make possibly 100% or more. So it's very much in the asymmetric camp. And so that's how I've come about this one and why I've done it.
All right, fantastic. Let's have a look at the last couple here. So EIQ, thank you.
Yeah, trend in this is still up. I'd be staying with it. I'd be hesitating to buy it at the moment. It's having a pullback. So far, the pullback is looks corrective. It seems relatively shallow, but would want to see it like starting to find support sometime soon. You just don't want to keep seeing back-to-back sharp down days. Then it like if we had another day like such where it just try that again. Yeah. Had another day like today again tomorrow, then you got a sharp rally and then it's given it all back just as quickly. That would be a sign of, at the minimum, a longer consolidation. I'd suspect. So I'd really like to see it holding the recent gains around current levels. Let the moving averages catch up. Maybe that sets up a new buying opportunity. But for now, for me, it'd be a hold. It'd be holding something which was bought at lower levels at a lower breakout point.
All right, thank you. XRG, you'd be the last one for today. Sure.
Low price stock. What I like about it, I like the strong rally off the low from last year. So that's a strong advance, and that's been followed by a proportional pullback to the moving averages. Like you could put some Fibonacci's on that. It's probably around the 50% mark. So yeah, you can see it's pulled back to the 50% Fibonacci region, and you measure that from using the low point to the high point, and then you get this green shaded area. That's like the Fibonacci retracement region. Won't go into all that today. But this has been, so it's been a proportional pullback into the moving averages. It's been tracking sideways, so it gives the impression that there's interest in buying it. Moving averages are still pointing up. If I had this, I'd be happy to keep holding it. Stop would be probably below. Like, is this like a ranging basing period? And it could be. So we could have a stop. Let's measure that. Probably needs 30% from here. So this would be the thing with, like, I don't know that it'd be a buyer here because 30% for one is a little bit wider than I'd like, and also like there's nothing to say this can't just continue tracking sideways for much longer. Like, could it just keep doing that for many more months? So that's why I probably wouldn't be in a hurry to come in and buy it. It'd be more a case of if we start to see this sort of price action and then it breaks up and then we get some consolidation while the moving averages come up and you start seeing a stepping pattern, rising highs, that's when I'd be more inclined to come in and buy it if I was inclined to do so. So it's there are things to be interested in it about. If I was holding it from a lower level, I'd keep holding it. If I was looking to buy it, I'd probably just continue watching it and try and buy a breakout should that happen. That's the way I'd play this one.
All right, thanks for that, Jason. I think we've gone through enough of the tickers today. We spent a little bit more time on having a look at those stop losses and trailing stops. So thanks for that, Jace. Thanks for everyone on the other side of the line for sending through your stock codes. I really appreciate you coming here once again for another great week. Don't forget to like, subscribe, and comment if you would like. And check out motiontrader.com.au for Jason's, obviously, service over there. If you haven't got a SelfWealth account, you can check out selfwealth.com.au as well, and that's the link just down below on the show here. All right, Jace, thank you.
Thanks, Rog. That's all been good. Hopefully that's been helpful and interesting to everyone watching. Thanks for joining us. And yeah, till next week, Rog.
We will see you next week. Stay safe in the markets. Bye-bye.